I want to talk to you a little bit about this chart that I feature every week in the Fed report of the Wall Street Examiner Professional Edition, and I occasionally post it free elsewhere. But this chart shows the relationship between money pumping by the Fed, the ECB, the European Central Bank, and the Bank of Japan. And this line is the 10-year Treasury yield inverted, so it's a proxy for the price of 10-year treasuries. The blue line is the ECB's balance sheet. It's the size of the European Central Bank balance sheet. As you can see, there's a tight correlation between the size of the ECB's balance sheet and the direction of U.S. Treasury securities prices, the inverse of yields. For the most part, yields have followed the size of the ECB's balance sheet, with a couple of exceptions where they began to lead here and here, and then the ECB's balance sheet followed. What happened was that each time the European financial crisis began to flare up, capital flowed out of Europe into the U.S. Treasury market and into deposits in the United States banking system. So as those crises flared up in Europe in the early to middle part of 2010, at the same time the ECB began to increase the size of its balance sheet. Then there was some respite in the crisis here, but the crisis again began to flare up in 2011, and more money flowed into the U.S. Treasury market from Europe. The response of the ECB was to float a dramatic increase in their lending to the banking system. Now, I must point out that they lend to the same banks that the Fed buys securities from, mainly the 21 primary dealers for the Fed, 14 of which are foreign banks, and 7 of those are European banks. So all the banks, all the major banks in the world, are dealing with both the Fed and the ECB, as well as the Bank of Japan, which I'll get to in a minute. So you can see that Treasury prices began rising here, yields were falling. What was driving that was the capital flight out of Europe in 2011 as the crisis worsened there. The ECB responded by printing money here, and that money helped to fuel a continued rally in Treasury prices. Then in late 2011, right here, the ECB began a program called the LTRO, the long-term refinancing operation, where they added approximately 300 billion, if I recall. I don't have the exact numbers in front of me. It might have been closer to 500 billion after they got through the second tranche of the operation in early 2012. So all this money that was lent to the the participants in the European banking system, which includes U.S. banks, European banks, and every other big bank in the world, then seemed to fuel the last rally in treasuries, the point at which the Treasury yield, the 10-year Treasury yield, got down to about 1.5% in May of 2012. The ECB then stopped printing money, and the Treasury rally stalled. The ECB allowed the repayment of the LTRO loans beginning in late 2012. So as you can see, the ECB's balance sheet began to shrink here. There was a little bit of a rally in treasuries, but the bloom was already off the rose in the second half of 2012 as treasuries began to sell off. And there was a little bit of a rally in the early part of this year. The ECB's balance sheet was continuing to shrink, and as that happened, there was more and more selling of treasuries. Now, what was going on here was that during this phase of the LTRO, many of the banks that took the LTRO funding simply turned around and used those funds to fund a carry trade in U.S. Treasury securities, since the yields on the treasuries were higher than what they were paying to the ECB for the LTRO funding. When the ECB began to allow repayment of those loans early in 2013, the banks began to unwind the carry trade in U.S. Treasuries, and this is where the selling began in the Treasury market. As I said, there was a brief respite here, but then that selling continued, and the unwinding of the U.S. carry trade continued as these LTRO loans were repaid. The bottom half of this chart, we show the Fed's balance sheet and the Bank of Japan's balance sheet overlaid with the S&P 500 here. And I'm not going to go into a lot of detail here, but you can see there's a pretty direct correlation. Every time the Fed stopped printing, that went into a pause in QE. This was QE1, which drove the recovery of the stock market in 2009, 2010. Then the Fed went into a pause. The market stopped going up, sold off. The Fed started printing again, QE2. Stocks followed right along here. And then when the Fed went into a pause again, second half of 2011, stocks sold off. The Bank of Japan was basically mimicking the Fed in terms of its quantitative easing program. So it helped to drive the rally in stocks, in U.S. stocks as well. And again, the Bank of Japan is playing with the same banks. 3 or 4 of those big Japanese banks are primary dealers with the U.S. Fed, so that they can direct these funds wherever they want. So the U.S. stock market was kind of like the last Ponzi game standing, along with the U.S. Treasury market. Here again, the Bank of Japan was radically expanding its balance sheet, and U.S. stocks were benefiting as a result. The Fed started QE3 and QE4 in here, and again, stocks tracked right along with it. But at this point, in early 2013, they began to experience some headwind with the paydowns of the ECB's funding. So it wasn't all a one-way street where all three central banks are working together. The ECB, the Fed, and the Bank of Japan were all working together up until the end of 2012, when the ECB began to shrink its balance sheet by allowing repayment of the long-term refinancing operation lending. So we no longer have a one-way street from all three central banks. We have 2 of the central banks that are still working together, but the Fed is threatening to taper its rate of purchases in September, and I think they're going to do that. So the going will get a little bit rougher from this point forward. Now, supporters of the Fed and most of Wall Street in general has argued all along that the Fed's money pumping via the various QE programs, and especially QE3 and 4, were responsible for driving long-term interest rates lower, therefore forcing mortgage rates down and promulgating this housing bubble redux that we find ourselves in again today. But is it really true that all this money printing by the Fed actually drove down long-term interest rates? From mid-November 2012, just before the Fed began to settle its QE3 MBS purchases, SOMA has grown by $790 billion. From here to here, that's almost $800 billion. The Fed has grown its asset base through the purchase of MBS and Treasury securities. The Fed began to settle MBS purchases, its QE3 MBS purchases here back in November of 2012. And from then to this point, it has added almost $800 billion to its balance sheet. But look what has happened to Treasury prices during that period. Again, these are prices, this is the inverse of yields. Treasury prices have been falling. Yields have been rising since the beginning of QE3 in November of 2013. So even though the Fed has been pumping massively over this period, we've seen a sharp rise in yields. Now let's go back and look a little bit, look at the history. Look at QE1, which started in March of 2009 and ran through June of 2010. Through most of that period, Treasury prices were falling, yields were rising. So here in this whole period of QE1, it didn't push Treasury yields down. Treasury prices first rose and then fell during the period where the Fed was pausing. So this second period of QE2 began in late 2010 and ran through June of 2011. Treasury prices were lower and yields were higher at the end of the period than they were at the beginning of the period. So again, while the Fed was pumping money furiously during QE2, Treasury prices were lower, yields were higher at the end of the period than they were at the beginning of the period. So during this period, again, there's zero evidence that QE pushed long-term interest rates lower. Then during the long pause between mid-2011 and September 2012, when the Fed announced QE3, during this period of a pause, when the Fed was not pushing money into the system, Treasury prices were rising and yields were falling. So only when the Fed was doing nothing did yields fall. And again, I described to you earlier why that was. It's because money was flowing out of Europe. The ECB was pumping money into the system. That money was fleeing Europe and looking to the U.S. Treasury market as a safe haven or as a carry trade. The evidence strongly suggests that QE was not effective in suppressing long-term interest rates. When U.S. long-term interest rates were falling, Euro capital flight was the driver. Each time the European crisis flared up, money flowed out of Europe into the U.S. Treasury market. Exacerbating those flows was the fact that the flare-ups triggered ECB money printing, which only increased the flows into treasuries as the banks took that money out of Europe and bought treasuries. In January of this year, the ECB opened the window for allowing repayment of the emergency LTRO funding program of late 2011, early 2012. The money flows into treasuries reversed when the Treasury carry trades that the cash had funded from the LTRO began to be unwound. The chart that I just shown you illustrates both the impact of the ECB funding and the lack of impact of the Fed's quantitative easing, which apparently was mostly funneled into U.S. equities. So I hope you've enjoyed this little discussion on what has driven both U.S. stocks higher. That's the responsibility of the Fed and the Bank of Japan. And what has driven the fall and rise of U.S. Treasury yields. That appears to be the capital flowing out of Europe and the repayment of the ECB lending. I'm Lee Adler. I hope you enjoyed this presentation. Thank you for joining me. Please visit me at wallstreetexaminer.com for my regular free updates on U.S. economic data. And if you're interested in my technical analysis of the markets, liquidity and monetary analysis, please check out the Wall Street Examiner Professional Edition risk-free for 30 days. I do hope to see you again. Until next time, this is Lee Adler.